Leen?
Yeah, my surname is D.O. The student ID is 19658520.
Oh no. You're different, Gurleen. Okay.
It is like THAO. My name is THAO. I sent to your mail last night the final.
Okay, Lidu?
Yes, it's Lidu.
Yes. Okay.
Hello, sir.
Yeah, give me a minute. Let me finish with Lidu first.
Yeah, did you receive the final submission of me?
I don't see any attachment actually, no.
No?
No.
Oh,
last communication you had with me about the decimal issues, right?
Yeah, and I resend you the PDF file.
Let me check.
I will send it now if you want to.
Okay, I see now. You have sent in one. Okay, I see now. Yeah, you send it to me.
I sent to
PDF copy, right?
Yeah, I sent two attachment, but like the second one is the final line. Yeah. Did you receive it?
Yes.
Yeah, thank you.
Yeah, I received it. Okay, someone wanted to say something, please?
Yes, sir. I also sent you the assessment as a PDF. So I sent you from the Monday. So did you receive it? Because you didn't reply me, so I don't know.
What's your name?
Yu Heng Lin. From Monday?
Yeah. Give me a minute. Yes.
Okay, cool, thanks.
All right. I will actually start replying to those students who has in by Sunday. If you guys have not done it, I'll know by myself anyway. All right, let's start here. Today we're going to talk about leasing. Okay. Now, there are two types of leasing we have: operating lease and finance lease. We'll talk about it. And we'll also learn how these leasing things actually influence our business decisions. Okay. Then we'll be talking about call and put options. And we'll talk about fundamental intrinsic value of an option. Now, let's just start with the leasing. The first thing comes up about what is leasing. So they defined here, a leasing is a contract under which one party, the lessee, agrees to make rental payments, lease payments, to the owner of an asset. So they need some, it's a way of actually financing your business. How do they do that? Like sometimes we need to borrow some capital for business machineries. To purchase business machineries. Then what we did, we actually went to a leasing company. Instead of purchasing it, we went to a leasing company. And we lease the machine. We make an agreement, we make a contract. We're going to use this machine, okay, for a certain period of time, and you're going to pay with a rental payment. That's a lease, that's a contract you make, and you pay the money. And later on, this leasing becomes two different types based on what type of leasing agreement they came into. Okay. So if it happens that they came to an agreement that most of the time of the total life, economic life of the machine is actually is more than the lease time. So the machine's operating life, for example, let's say 20 years. You lease it for 8 years, 10 years, like this. Is operating lease. And you will be, what you're gonna do? You will be actually own the machine end of the day. In finance lease, most of the economic life of the machine, non-cancelable. Okay. Yes. You can actually you can actually purchase the machinery too after these things. After you, sometimes it happens that most of the time you are actually using the machine. So at the end of the day, you will be actually purchase the machine too. Okay. All right. So now the question will come up, should we purchase or should we lease? This is the question we have. So should we purchase or should we lease? That's the question they have. So we have two different approach to answer this question. Should we purchase or we should go for leasing? Okay. So two approaches are here. Approach 1 and approach 2. Okay. Before I go and talk about these approaches, I would like you guys to actually enjoy a video. From 2009, okay, there is a good decision was made about leasing. Development was brought into attention, which was this, that investors are sometimes being misguided. How they are being misguided? They are misguided like this, that a company, so most of the investors, they will be actually interested to invest in a company where there is less liabilities. So two different types of companies for the same type of business, for example. Let's say one is aircraft industry, airlines. So when you purchase, two ways you can run the business. One is purchasing aircraft, another one is leasing the aircraft. So the companies who is actually purchasing the aircraft, they might have taken a loan from bank and purchased this aircraft. So on the balance sheet, you can see a lot of liabilities are there. Why? Because they have taken bank loans to purchase this aircraft. On the other hand, the companies who are actually leasing this machine, okay, since they are leasing the machine, and this machine, I mean referring to the aircraft. So this machine is their operating lease because they are actually using this machine for operations, business operations. Okay, and according to the standard, accounting standard, the standard we follow is actually IFRS standard Australia follows. Okay, it's in the name of AASB. Okay, and we actually follow. AASB actually approved that IFRS rules we're gonna follow. So now they actually brought some changes now. The previous standard was there, that the rule was there that on a balance sheet, companies will not have to show any operating lease. They will have to show only the finance lease. As a result, the companies who are leasing these machineries, they will not show their lease liabilities on the balance sheet. So this is a situation where the investors might get misguided. And IFRS brought some changes into this. I want you guys to actually enjoy this video from this gentleman. His name is Hans Hugerbrost. Hans Hugerbrost. Okay. About leasing. Okay. This is a 6-minute video. You can watch it.
We have just issued a new lease standard, IFRS 16, which replaces a very old lease standard, IAS 17. We really feel there's a need for a new standard because the old standard does not truly reflect economic reality. Companies have a lot of leases outstanding, more than $3 trillion. And only a limited amount of these leases show up on the balance sheet. All the rest, the so-called operating leases, are not shown on the balance sheet. And at the same time, they really represent a real liability. And therefore, we think the fact that such a big chunk of liabilities is not on the balance sheet does not truly reflect economic reality. Well, many investors, but not all investors, many investors, the educated investor has been making their own adjustments, multiplying yearly lease payments, for example, by 7 or 8 times. These are very rough estimates. Often they end up overestimating the lease liabilities. And then there are a lot of investors out there who do not adjust the numbers, and they are sort of misled by the current numbers. The big change of the new standard is that in principle, all leases go on the balance sheet, both operating and finance leases. The only exceptions that we make are for short-term leases, leases that are shorter than 1 year, and what we call small ticket items, very small leases, for example, for office or, furniture or for iPads. And that means that the investor will from now on get a good view of all the lease liabilities and not just the finance leases, such as is currently the case. Well, I think there are 2 big benefits to the markets and to investors. First of all, there is a better transparency. There is more insight in the liabilities caused by leases. For example, during the financial crisis, quite a few retail companies went bankrupt. Their balance sheets were very clean. They had few debts on their balance sheet. At the same time, they had huge leasing liabilities which were not visible. In the future, these will be visible. So that's one. Second, there will be much better comparability between companies. For example, there are now airline companies that own most of their aircraft and finance it with loans. And on the other hand, there are airliners that lease most of their fleet. In practice, they might have similar financing obligations, but in current practice, the company that owns the airplanes has a lot of debt on its balance sheet, whereas the airline that leases most of its aircraft has a clean balance sheet. And that is not a good comparison, and the new standard will create more comparability between these companies. Roughly half of companies around the world do have leases, so a lot of companies will be affected, but especially will be affected companies that have a concentrated use of leases, such as the retail industry, airlines, and shipping. Those are sectors that have heavy concentration of leases, and they will be most affected. We do not expect this standard to just be met by enthusiasm. I think investors will largely be enthusiastic, but companies might think that there will be quite a few costs involved. Well, we have tried to keep those costs as limited as possible. And at the same time, I think the standard will also provide management with better insight in the true extent of their lease liabilities. And I'm sure that a lot of managers are not completely aware in detail about these liabilities. And it might lead to better decisions between leasing on the one hand and buying and financing of equipment or whatever you might lease on the other hand. And it might lead to better capital allocation, better management decisions. We have seen before that when we changed the pension standard, that it led to new awareness of companies of the true extent of this liability. And I think the same will occur with leases. At the same time, I am absolutely convinced that the standard will not put the leasing business, the leasing companies out of business, because leasing will remain a very attractive instrument for many companies. It is a very flexible way of financing your assets. And on the other hand, it's also a good way to sort of own assets without having all the full risks of ownership. So I think that leases will remain an interesting business proposition, and we will certainly not put the leasing industry out of business. The effective date of the new standard will be the 1st of January 2019, so that should give companies ample time to prepare for the new standard. I think most questions around this new standard will be about the weighing between costs on the one hand and the benefits on the other hand. That's the reason why we have performed a very detailed effect analysis, which will be published together with the standard. In this analysis, people can see what are the costs of the new standard and what are the benefits of the new standard. And I think when you read that effect analysis, that the conclusion can only be that the benefits outweigh the costs.
Okay. So he was talking about how the management are actually using this loophole of leasing standard. So they're actually fixing this problem. Now let's start to our topic again. So two ways we can actually check. Like again here the question comes up, should we actually go for leasing or go for buying? Okay, to answer this question, we can do it in two different ways. Okay. What are those two different ways? One of them it says simply compares the present values of after-tax cash outflows associated with leasing and purchasing by borrowing the capital required and paying off the loan over the term equal to the lease term. The course of action with the lower of these present values would be preferred. This is one method. So what they're doing here, they're actually checking the present value of all the after-tax cash outflows, okay, of leasing, and they will check the same thing for purchasing, and they will make a comparison, and they will see which one gives them a better profit. This is the thing we're gonna check. And second one, we will actually directly we will be calculating net present value of the project leasing, referring to the usual relevance after tax incremental cash outflow. This is actually they will be comparing both the thing. They will check the difference of the money and how this difference can be actually covered. That's what they're going to check on here. Now let's go through one sample question. Yeah. Okay. Try to make it bigger. So suppose a situation in which a private university is considering whether to buy or lease a car for use by its vice chancellor. The appropriate car cost is $81,000 to purchase. Alternatively, a finance lease can be arranged involving 5-year lease payment of $20,000. And the car can be depreciated using straight line depreciation over 6 years. That's another information we have. Assume that under the lease arrangement, the university would purchase the car at its book value, okay, which would equal its residual value at the end of 5 years. That's another information you have. University pays an effective tax rate of 30%, and it would be able to borrow to purchase the car at a before tax interest rate of 8%. Maintenance cost on the car are $3,000 per year paid by the owner. If they purchase, then they get the owner. Should the car be leased or purchased? That's the question we have. Okay, this is our question. Should the car be leased or purchased? Okay, so we face this type of question all the time. So you have these informations here. Okay. Maintenance cost. This is our information. There's our information in here. Okay. Now we need to solve this problem. What are you gonna do? We're gonna check the net present value of cash outflows of purchasing if they purchase, and we're gonna check again about net present value of if they go for leasing. Let's do it. So calculating after tax cash flows associated with leasing. So first you're checking with the leasing. How they're doing it, I'll show you now. Okay. So they have around 5 years lease. First question will be, why did they start with 0? They start with 0 because in here they said, which is checking lease, okay? A finance lease can be arranged involving 5-year payment. The payments made at the beginning of 12 months. It means their payment should be made at the beginning of the year. That's why you will be paying actually at year 0 present today in advance. Okay, that's the first one. And because of the 30% of your tax, 30% tax or 30% of this lease payment, and this lease is actually tax deductible. We mentioned that as well. I'll show you here. Lease payment are tax deductible by the lessee provided by the asset. Okay. Yes. Tax deductible. Okay. Anyway, you can see that here. Lease payments are tax deductible. Also, interest is also tax deductible. This is business expense. Okay. So this 30% of this $20,000 will be your tax shield or tax savings. Okay. But look at the year 0, we are making the lease payment, but $6,000 tax shield you're getting after 1 year. Why? Because tax will be calculated at the end of the year. Okay, that's we get it at the beginning of year 1. Okay, see? So first year $20,000 you pay. So after tax cash flow will be 20,000. Second year 20,000, but you will receive your tax shield of 6,000, 14,000 you're gonna pay cash. But the last year you will receive tax shield of $6,000. But at the same time, you have to make $30,500 for your machine, the car. So what is this? Look at here. This says here, assume that under the lease arrangement, the university should purchase the car at its book value. So how much will be book value after 5 years? At the end of 5 years, book value will be here. Look, every year depreciation will be $13,500. Yeah. Okay. Here is the figure. Okay, $18,000 is a car, so 6 years, so every year will be $13,500. So under the lease agreement, year 0, 1, 2, 3, 4. These 5 years, okay, of the car is on the lease. The last year is book value. How much is left? So every year $13,000, like here, they did it in here. Look, $13,000 into 5 years. So this is equal to 81,000 minus 67,500. Okay, equal to 13,500. That's the value they have. Okay, that's the book value after 5 years. So you have to pay $13,500 book value to get the car. Yeah, but that year you don't have to pay any lease payment. So you will be receiving $6,000 of tax relief from the previous year's payment, and you have to pay $13,000. So in total net, you have to pay $7,500. So this is your after cash outflow. Now we are going to do, what we're gonna do, we're gonna actually calculating here the present value of this figure. Okay, present value of these totals. All right, so look at here. Interesting thing, we have actually, let me make it bigger. Here. So the present value of cash outflow associated with this lease is this much. How did they calculate it? Look here, they calculated the first, look here, three things in here. I'll show you the 3 things. Look at here, I'll show this too. And the equation, brackets, and put them in this. So look, this is one part, this is 2 part, this is 3rd part, 3 parts in here. Okay, they have 3 parts in here. Yeah. So first part is about their year 0 payment, $20,000. First part is there, year 0, $20,000. But this is already present value in here. Second part is that these 4 years of $14,000. Second part, yeah. Okay. What did they do here? They have actually done here, they used annuity formula. Okay. So first one is present value itself. Second part is annuity formula. Third part, $7,500. This one they used as a present value. But the question you will notice, interesting part, you will notice that they used here 0.56. What is 0.56 here? This is your interest rate. But in question, they says here that in tax interest, before the tax interest rate will be 8%. So why did they use the 0.56? This is called effective interest rate. After tax cost of debt, here they showed you that after tax, when you use the after tax cost rate, interest rate, that will be this. Interest rate multiplied by 1 minus tax rate. Okay, that's the formula. You say here, R multiplied by 1 minus T tax rate. This. That's how they got the effective interest rate. Okay. And the answer they got it here, 74,670.53. This is for your, this is the amount of money you have to pay if you take the lease. Present value of all these figures after tax and all the payments, okay, making all the payments, this 5 installment of $20,000, the leasing agreement they made, present value of this 5 installment will be today 74,670.53. Now we are going to calculate here, if we purchase, how much it will be. Okay, how much it will be if we purchase. Okay, this is second part. Okay. Now we're gonna calculate here what's happening that if we purchase this one. So when you make a purchase, okay, here we know the formula is in here. Let's make it bigger. Present value annuity will be equal to this. So we calculated it here. Payment will be how much? Payment will be PVA divided by this whole figure. Yeah, that's what we have done in here. Okay. And how much will be the payment here? So we know PVA, present value annuities. How much is that? $20,000 in there. Okay. And the costing here is PVA is how much? $81,000. Sorry, that's for the leasing for 20,000. And RD interest rate is 8%. Okay, the payment that you have to make is this much, 20,286. Okay, so you're gonna take a loan, and 5 years time, how much you're gonna take a loan? You're gonna take a loan $81,000. You're gonna take a loan. Present value amount of this $81,000. What is you have to payment value? Yeah, sorry, payment will be $20,000, 286.97 you'll be paying for 5 years. Okay, to pay off this $81,000 that you're gonna receive. $81,000 is the amount of money you need to buy the car. You take this money as a loan from the bank, and you have to pay interest as 8%. Okay, so it means 20,287 is your payment for every year. So now you do it here. So it is included with interest too. Okay, so we are saying here that $81,000 is here. And 8% interest of 81,000 will be 6,480. But you made a payment of 20,286. Every year you make payment 5 years. Okay. So if interest out of this $81,000, you're making payment of $20,000 is this much, and this has included interest and the principal too. Interest is 6,480. You make a payment of this, the rest of the amount is deducted from your principal. Next year you make 8% interest on this figure. Is everything all right? Okay. Then you get here a table. This is called loan amortization table. So 5 payments of these things, 5 payments of 20,286, it will be covering you 8% interest for next 5 years. Now you will have to calculate the outgoing of this amount. Okay, how much money actually after tax, how much is outgoing actually, real outgoing actually. That's what we're gonna check now. So this is our next table. On this table, we are going to check cash outflows associated with the purchasing. We're going to check this part now. Okay. And you see here, you are making a payment of this 1, 2, 3, 4, 5 payment, loan repayments. Since you are actually owning this car now, you will check how much, what benefits you will receive from this car. Okay, and how much money you are paying. That's what you're checking now. To maintain this car, you need $3,000 every year. It mentioned in there. Yeah. Maintenance cost on the car is $3,000. Depreciation $13,500. We already showed this one before. And the interest payment you're making for every year. See? This is the interest you're making for every year. So we're calculating here, total tax deduction is how much? This much is tax deductions every year. This much will be loan payment, maintenance cost, depreciation, these things. And out of this, you have to check 30% you're gonna save from the tax. That's tax shield, this much, 6894. And after tax outflow, how much is this figure come from? 16,392. This comes from loan repayment. Loan repayment plus maintenance cost. Okay. Okay. That's it. 16,392. Okay. Oh, minus tax shield. Yeah. Tax shield is in there. This plus this minus this. Okay, tax shield. Yeah. Okay, that's it. So you calculate these things for all these three of them. So maintenance cost, loan repayment, maintenance cost 3,000, and your this figure minus this. Use this formula and you calculate your after tax outflow. Okay. And then you calculate, you can see now your after tax outflow is this figure. These numbers are after tax outflow. Okay. Then what you do, you calculate the present value of these figures. Look, they're all different numbers, right? There we cannot use annuity formula here. We have to calculate all each and every of their. See, there is no year 0 here, so these one will have to be by number 1. Okay, so see this figure divided by 1 plus I to the power n times. For this one, this is year 1, it will be 1. This is year 2, this will be 2. This is year 3, this is year 3. See, 17,082 divided by 1 plus I to the power 3. That's how you calculate. So how much you got your answer? 72,695.73. So if you go for purchasing this car, the present value of your outflows will be 70, after tax cash outflow will be 72,695. And here, if you lease it, it will be 74,000. So we will prefer purchasing over leasing. This is the whole point. So this time we're gonna actually go for purchase, not the lease. Okay. We're going to talk about second point. Any question for me for the first approach, guys?
No, thank you.
No, no question.
No questions.
Okay. Let's do approach 2. Okay. In this case, we'll be calculating net present value of the project, leasing, as opposed to the purchasing. We'll do it as leasing opposed to the purchasing. So what are you doing? Let's say decided to buy. Cost of the car, purchasing. Okay, it's $81,000. Now we will show here what happens if we go for leasing. Can we recover this purchase with leasing? That's what we're going to check. Okay. So at the beginning, $81,000 needs to be paid spot on. On the first year, if leasing payment is actually $20,000, so $61,000 will be left for the next 4 years. Sorry, next 5 years. Okay. Now, every year they're going to show you here. Look, 1, 2, 3, 4, 5 years. 5 payments. First one is paid. We're going to pay next 4. Okay. And some of our payment, look here, our tax will be coming actually at year 6, not year 5. Because we are using from year 0. Okay. How they're showing here? They said tax savings due to lease payments, $6,000. That's right. If you buy, and after at the end of the, if you go for leasing, end of 5 years, you have to make the payment for purchasing the car. How much you have to pay? $13,500 you have to pay. Okay. Yeah, purchase options. And depreciation will be, depreciation tax savings will be 30% of $13,500 every year. And maintenance savings will be how much? If they go for leasing, maintenance savings will be $3,000, but maintenance tax shield will be forgone for $900. Okay. So they calculated this figure. Incremental cash outflow, 61,000, this figure. So $61,000, let's say, is your gap. Did you manage the $61,000 with all these 4 or 5 payments? Okay. We're going to check the present value of these 5 payments, whether they're equal to 61,000 or not. Okay. We check that. It is actually value of $62,000. Okay. The actual value not 61, actual value of $62,000. Okay, but we needed how much? $61,000. Okay, so purchasing will be giving us a $1,974 of benefits. Any question for me, guys? Any question? No? Okay.
No.
Okay.
No, sir.
Let me check. I got a message. No. Okay, all right. Now let's move on. We'll be talking here about derivatives. Okay. What is derivatives? Derivatives is a security whose price depends upon or derived from one or more underlying assets such as stock, bonds. Derivatives is a contract between two or more parties based upon the assets or liability assets. Derivatives either be traded over the counter or an exchange. OTC derivatives considered good. Okay. So this two is the important thing for us. Okay. So what derivatives are actually here? We are making a contract. Our contract is actually based on other shares, bonds, commodities, currencies, interest rate, market indexes, these things. Our agreement is based on other things. For example, let's say we all want to make some profit. If a share is sold at $20, we will be more than happy to buy it at $16 because we have profit in here. So if you can purchase 100 profit, 100 share like this, okay, you are having actually, look, 4 into 100, $400 profit. To make this agreement, if you need to make a fee or the price to buy this type of guarantee, per share if you pay $1, 100 share, $100 you're gonna pay. Okay. So there is an opportunity like this, it's called options. By using this option is one of the derivatives. If you purchase options, it will give you the right, okay, to buy or sell of some items, some shares at a specific price for you. When you purchase at a lower than market price. At what price you're gonna buy? That is called a strike price. Okay. At the same time, or even somebody else, not at the same time, you can also purchase, not purchase, sell shares. When you make sales, you'll be selling at a higher market price within a specific date. There is no guarantee that share will be going that high or you're gonna do these things. No guarantee in there. Okay. So two different types of options we have. One of the options called put options. Another one is called call options, two of them. call options and put options. Call options means right to buy. Put options means right to sell. Okay. Yes. Now there's an example in here. Here's an example. Okay, here's an example for us. Okay. So here it is. Say an investor buys a call option. Call option. Call options give them the right to buy. Okay. To buy 200 shares. You're buying it. Okay. The price for the call option is how much? $1 per share. You have to pay $200 for these 200 shares. Strike price is 15, so it means you'll be buying at 15. Good, you'll be buying at 15. Very good, very good. Okay. When you're gonna do it, let's say a date. Today is 14th of May. Let's say this is 15th of September. By within 15th of September, they are going to use this derivative. Okay. By 15th of September. Okay. And now, at the expiration of the option, the price of the share is $17. By 15th of September, you found that the price share is $17. What is gain? What is loss here? Okay. Today, the price is $10. Share price $10. And you said that you're gonna actually pay $15 for the share price. You'll be pay $15 to buy the share price. When? By 15th of September. So you wait and see how much the price goes by 15th of September. You found that at 15th of September on that specific date, or within this date, let's say 12th of September actually, the price went to 17. You want to exercise your right. If the market price is, let's say, at that day is, let's say, 14, will you go exercise? No, you will not, because you said you're gonna pay 15. So when the market price is 14, you will not be using your rights. Okay. Here it is. Initial investment is $200 that you paid to buy the options. Since the price of the share is above the stock price at the time of expiration day. Okay. At the time of expiration date, or you can say within 15th of September. Okay. 15th of September. The investor will gain how much? 17 minus $15, he's gonna pay $2 each. $200, $400 minus initial investment, $200. That's their profit. Easy. Second one is this. This one is put options. Put means you sell. You're not buying this time. You're selling at what price? Higher price, always. Isn't it? So Mr. Martin, what he did, he bought a put option to sell 100 shares. His strike price is 70. He's gonna actually sell this item at $70. Okay. Current market price is how much? Current market price is 65. Again, let's say September, within 1 month or 2 months time. Price of the put option to sell one share, $7. So to purchase these things, to purchase this put option, they have to pay $7 for each share. He wants to do for 100 shares, $700 will be his initial investment. On that expiration date, he actually wants to sell at $70. So if market price is 65, or let's say 67 or 69, okay, he can sell at 70. He gets some benefit. How much is market price on that day? That's what you need to find. Under the term and condition, Mr. Astor can sell shares for $70, realize a gain of $20 per share. Okay. Therefore, the net gain will be $20. Okay, into 100 shares minus 700. So it will be $1,300 will be his profit. Okay. So they said that he realized a gain of $20 per share. So it means share prices went down to $50. See, at the expiration, at the time of expiration of the put option, the share price is $50. Okay. So he gained $20 each, and he sold how much? For $70. So you get a gain of $20 each share. If the price is, let's say, 80, then he will not be making profit. He will not exercise this power then, but he's not getting benefit. Okay, good. Now we'll be talking about intrinsic value. Okay, fundamental or intrinsic value. That's what we're going to discuss now. So this says here, intrinsic value of call option. See again, call option. Call means right to buy. Okay. Right. This is not a legal obligation. This is just a right. You have the right to do that. If you don't want to practice your right, that's fine. Nobody's going to bother you. Okay. Intrinsic value of a call option or right to buy option is the excess of the market price. Excess of the market price over strike price. So how much? Okay, they can buy it at a lower price. So market price is actually higher by over the strike price. By how much? That's what you're going to calculate. Okay, if this is positive. If it is not, the answer is still 0. There is no question of how low. Okay, answer is 0 because they're not going to actually apply. Okay. So they have an example in here. What is the intrinsic value of the call options, or the fundamental value of the call options, to buy 1,000 shares with a strike price of $15? So if strike price is $15, then they're gonna buy 1,000 shares. Okay, good. Market price is how much? 18. Market price is 18. You can buy at 15. So you're gonna actually use your rights. Okay. Fundamental value of the call option. How much you're gonna gain? You're gonna gain $3 each share. For 1,000 shares, $3,000 will be your gain. But look at here. If the market price is $10, then what happens? Then you are not going to apply for, then you're not going to exercise your right. You're not going to actually use this option because market price is 10. Why are you going to buy it with 15? You will not. That time, the value of that call option will be 0, no value. What is the value of this call option, using this call option? There is no value. Why? Because you're going to lose your money. Simple. It becomes useless. They have 2 examples in here. Okay, is there anything else in here? I don't think there is another. Okay, now we're going to do our exercise. Okay. So first 3 questions is our theory questions. We're going to look at that. Okay. And this 4, 5, 6 is our 4, 5, 6. This is our problem solving questions. These questions we will not do in tutoring classes, in these classes. That's it. So you have to finish up this 4, 5, and 6. 3 questions. Okay. Let's talk about these 3 problems. Why do we use market interest rates instead of historical interest rates in calculating a firm's cost of debt? Why do we prefer to use market values instead of book values? Good question. Okay, that's a good question. Why do we use market interest rate instead of historical interest rate in calculating for cost of debt? Why do we prefer to use market values instead of book values? The answer is we're interested in estimating what would be the cost of the firm issuing additional debt to finance project. And second point is the return required by prospective investors in the firm's new debt will be given by market rate of interest. Because the investors who are actually investing here, they will check if whether should I invest in here or invest somewhere else. At the current time, what will be the market interest rate? That's what the investors will be expecting. So that's why firm will also be calculated using current market rate. Okay. Second one. This question is, why do we prefer to use market value instead of book values? Market value of the firm, this will reflect the return, okay, required by the investors for the new debts. Okay, so they will be expecting that at least the investment will be equal to their firm's market value. Why do we assume business and financial risk are unchanged when evaluating the cost of capital? Why we assume that? Okay. New project. Okay. The thing is let's say we assume that business risk is same all the time. Okay. And if it happens that it does not have the ability to pay off operating expenses, that is called your business risk. Okay. It says here, let's say business risk is always constant. Okay. So whether you take a new project or not, if you cannot pay off the operating cost, nothing to do with the cost of capital in here actually. Same for the finance as well. Finance costs are interest, leasing payment, interest payment. Okay. Then other financial expenses, debentures maturity payment. Net proceeds from the sale of bond, how much you will gain from the bond, that's it. Okay. What is flotation cost? Flotation cost are the total cost of issuing and selling a security, a share. Okay. All right. There's your question number 4. In January 2013, the CFM Corporation considered a project requiring an initial investment of $200,000, subsequently yielding the $200,000. To $30,000 will be coming regularly for 10 years. New debt of was 8% per annum. Okay. And at the, one year later, CFM had the opportunity to invest another project, Project B, which required initial investment 200,000 again, expected to yield annual after-tax 11 incremental cash flow of $36,000 for $10. So there are 2 projects in here. On this next project, Project B. So this is Project A. And this is Project B. They're independent. Independent project means they can choose any project, both the project. Okay, initial investment is $200,000 for B. 36,000 for 10 years. Okay. Okay. All right. If the farm had simply used the cost of the lowest cost form of financing to calculate the net present value of the project A in 2013, what would have been the net present? How much would be the net present value? So let's do it. So project A is equal to, how much is their payment? $30,000. Okay. And they will have to make a payment of $0.08 minus the 2. How much will be the answer? Okay. That's it you do for net present value for a project A. Let's get the answers from there. The answer is $1,302, which is positive. They should go for it. Suppose that based on the result of Part A above, CFM Corporation undertook Project A in January 2013, using only debt financing to raise the capital to cover initial investment. As this exhausted the firm's debt raising capabilities, it evaluated the net present value of Project B a year later. After 1 year, they're thinking about Project B, using its cost of equity, which for simplicity we assume unchanged 13% per annum. So the interest rate is 13%. It will give them how much? It will give them again 10 years. Remember 36 on the other one we did. I showed it in the other one. 36,000 for 10 years. Okay. But interest rate will be how much? 13% for this time. It will be exactly the same thing. Same way you calculate it. This will be project B. And this is not 30, this will be 36 actually. This is not 0.08. This is 0.13, 13%. Here it will be the same. 13% minus 200,000. That will be the answer. How much is that? Okay. Yeah, exactly the same thing. 4,655. After 1 year, they're going. If they move in, they will have also positive value coming up. By how much? 4,000. But net present value previous one is 1,300. Last point is, if the firm had instead used a weighted average cost of capital of 50-50 sharing, okay, then what would happen? Okay. So this will be taking 50-50 divided by 2 average they are taking. Also, if you follow other way around, other system, like the way we did on the last time, this is equal to so let's say here W interest and W is the weight, and here this is R. Okay. R. So this is, let's say we could do here, another one is R. So let's say it is project A. Project A, interest rate for A, plus okay, project B, how much it will be? Same thing, 50%. For first weight is 50%, 0.50 multiplied by rate is, how much is the rate for project A and B? A was 8%, 0.08 plus again 50%, 0.50 multiplied by, this one is 13%, 0.1, 13%. You put them in bracket, it will be nicer. You can understand it easily. Same thing. This will be equal to, again, 0.04 plus 0.65. It is equal to, it will be again 10.005. Same thing. Okay, that's it. Done. Same answer you will get, both the way you go. Sanya, you now you use, this is your work. W. Now I use this 10.5% as interest rate for project A, for project B. Done. Okay. Let's go to number 5. After careful analysis, Dexter brother okay, they have 3 different sources: long-term debt, preference share, and ordinary share. 100%. So 30, 15, 55. This is their W's. WI, WS, WP, three of them. The cost of debt is estimated 7.2%. The cost of preference share is 13.5. Now they're giving you here. I don't know why they did not give it there. On the interest rate. Three of them. How much is the first one? %7.2%. 7.2%. Second one is 13.5 and 16. 0.5%. Third one. That's it. So we know now W and we know I. The cost of new ordinary share equity estimated to be 16%. They have flotation cost here. This is a flotation cost. Now it's going to change. All these are after tax rates. Currently, the company's debt represents 25%. That now currently is 25. Capital representing 10%. Ordinary share is 65%. So current situation is this. Debt is 25. Preference share is 10. Ordinary share is 65. Okay. The company expects to have a significant amount of retained earnings available and does not expect to sell any new ordinary shares. So calculate the WACC. So WACC calculated by using this 30, 15, 55. Here. And this is their interest rate. But this will be their historical rate. Historical rate means current situation. And after they take the loan, this will be their situation. Okay. When they take the loan, that will be the situation there. Okay, it's not that gap. Okay. For the number C. So one is calculate WSEC based on the historical market value, historical one, and another one is target one. Target is after you take the project. A historical one means current one. That's it. 25, 10, 65, that's current value. Yeah, 25, 10, 65. Multiplied the same rate you use. Compare the answers obtained in part A and B. Explain the differences. So what these differences you have? The differences lies in different weights used in the calculator WSEC. Just the weights is the difference in here. Okay. So long-term debt is increasing. Preference share is increasing, but ordinary share is decreasing. Last one. The Dr. Phil Media Corporation faces an effective company income tax rate 30%. The firm is financed with debt, preference share capital, and ordinary share, three ways. Regarding debt, the firm has 5,000 corporate bond on issue, each with a face value of $1,000 and a maturity date in 5 years. 5,000 corporate bonds, okay. The bonds pay interest annually with a coupon rate of 7.5%. The current yield to maturity is 8% per annum. Okay. preference share. So we're gonna actually calculate from here. We're gonna calculate our actually rate. We're gonna calculate long-term debt rate. We're gonna calculate from here. For preference capital, 100,000 shares on issue. The value has $10 per share per value. Annual preference dividend will be 8% per value. So 8% of $10. Oh wow, 80 cents. Okay, the current preference share price is $8. So the current price is $8. So price has actually gone down. Ordinary shares, 4,000 ordinary shares are on issue. The current ordinary shares is $6 per share. Equity beta for use for these ordinary shares. Okay, is 1.1. The expected return on the market portfolio, how much will the expected return on market portfolio is 7%. The risk-free rate is 4%. The government rate is 4% risk-free rate. So this is important one. The market MRF is equal to this one, ordinary shares. All right. Given the above information, assuming the capital asset pricing model is valid. So CAPM, you're gonna use CAPM model. CAPM model is valid. Calculate the current weighted average cost of capital WACC. The current WACC for the Dr. Phil Media Corporations. Okay. So what they did, first calculated the debt. What is the percentage for debt? Then they're gonna calculate the preference share capital percentage. Okay. Or the market value of the debt. Then they're gonna check about what is their market value of preference share, and they're gonna check out the market value of their ordinary shares. Let's check it here. So market value for each bond is how much? The first one, debt, 5,000 corporate bond. Okay. 5,000 corporate bonds, and they said it is face value was $1,000. Okay, and they're gonna get 7.5%. Was the coupon rate? Look at here. Coupon rate 7.5%. The coupon rate per annum. For $1,000, it will be $75. That's the payment they will have to make on this bond. Okay, and we're gonna use this annuity table because it will be keep going for how long? They said by maturity year, bond interest and due the current 8%. So how many years? 5 years time. Maturity is 5 years time. Maturity in 5 years time. So use the annuity formula for 5 years time at 8% interest rate. Maturity in 18% interest rate. That's what you're gonna calculate here. Okay, and we'll be using this coupon rate to calculate our annuity value. How much will be annuity values? Okay. Okay. We got 75 annuity values, and we calculated this way. See that? 75 into 1 minus 1 plus r to the power minus n divided by 8%. Plus, at the end of the 5 years, they will be returning back how much? Face value is $1,000 face value. What is the present value of those amount? This much, $980. So total market value for the debt will be how much? There are 5,000 shares like this. See, $4,900,000. For preference share, they have 1 million. How many shares they have? 100,000 preference shares on an issue that have $10 per share value at 8% interest rate they pay. Okay, So yes, shareholder, they have $8, 100,000 shares, 800,000. How much will be the price? Dividend divided by rate. Dividend is, see here, 8 cents, $8. So because $10 is the share. Okay. $10 is their share par value. So dividend will be paid on the basis of par values, $10. Okay. Yeah. So anyway, market value is this much. For ordinary shares, 240, straightforward. Okay. Now they used here CAPM model. Here it is. CAPM model they used, and they found it how much? 7.3%. And the farm value is 8.1. So WACC will be, now you calculate the WACC. How did they calculate the WACC here? 4.9 debt this much of debt, preference shares to calculate these things, debt, preference share, and here is their ordinary shares. Okay. So, and they calculated the rate of return at 7.3% CAPM method. So yes, and they got it, the answer 6.5. Yes. Okay, let's do our attendance in here. Okay. Daniel, you there? Hello? Is Daniel there? No. Huang Ham Cho? Huang Ham Cho? No. Thomas? No. Li Pung Tao Do?
Yes, it's me.
Thank you. Gurlin Kaur? Gurlin Kaur? Priscilla? No. Bahi Imam? Well, when Kuriakose? Ihan Le?
Yes, Professor.
Yes. Venkata Saiposa? Ananya Rizal? Timothy Smith?
Yeah, yeah.
Jun Kayong?
Yeah, I'm here. So I'm here.
You are?
Jun Kai Wong.
Jul Kayong. Chuan Bak?
I'm here.
Yu Heng Lin?
Yeah, I'm here.
Liu Hui Fei?
Yeah, I'm here.
Jacob Loveday?
Yeah, I'm here.
Wei Jian Jiang? Wei Zhang? No. Li Hui Dongji. Did I miss any of you? No. Okay. All right. All right. Do you guys have any question for me? No?
No, thank you.
Thank you very much then. Okay, I'll end up the meeting then. You have a good weekend too.